Good morning and welcome to Coffee with Bob. I'm Bob and Christina is here today also as usual. And today we're going to be discussing the 3 reasons to diversify your mutual fund companies. Chris?
Yeah, thank you everybody for tuning in today. This is a pop-up episode of Coffee with Bob. So it's not a live episode. We bring these episodes to you every other Wednesday, whether it's live or a pop-up. So tune into future episodes and please share this with anyone who you think would have interest in this topic or any of the other topics that we've covered in the past. So today we're talking about the 3 reasons to diversify your mutual fund companies. When we think about diversification, I think the go-to is thinking about diversifying your portfolio between stocks and bonds or within stocks and bonds in the appropriate way. But there's an aspect to diversification that we really think it's important not to overlook. And that's diversifying the actual mutual fund companies that you choose when you're choosing the securities to put in your portfolio. So what we've done today is we've identified 3 of the top reasons that we think you should be diversifying your mutual fund companies, and you can see them here on the screen. Now we have our cups of coffee, and in true fashion for Coffee with Bob, we hope you do as well as you enjoy this presentation. So let's jump into these 3 reasons. Let's talk about groupthink. Bob, explain what groupthink is and the significance behind it.
Okay, so if your money is invested all through one institution, you're usually getting the same ideas and philosophies across your entire portfolio. And so what you really want to ask yourself the question, is that what I really want? Is that in my best interest for the long term? It may work in the short term, but if you're really thinking about long-term success, which most of us should be thinking about that, then this is a very important part to consider. So groupthink is, if you think about it, if you're in a confined group, your household, your family, or just your office, you don't communicate with anybody else, you're going to have your own thoughts and patterns and ways of doing things, and it may not be the best. You could have some things you do very well and others that you don't. So in essence, it's a form of concentration risk, and it's basically the same people making the same decisions over and over again without any outside thinking or influence, and that can be problematic.
Absolutely. Okay, so let's move on to the second reason, tax timing. Bob, can you explain what tax timing means and its significance?
Yep. So, before I actually talk about tax timing, I want to talk about taxes. We're like everybody else. We're patriotic. We want to pay our fair share, but not a nickel more. And we want to control. We believe our clients, our friends should control when they're going to be paying taxes, not some mutual fund company in Los Angeles or New York or something like that. So we want to have that control over predominantly when taxes are paid. We think that's a good thing. That way we can plan for taxes and minimize them, and capture taxes when it makes the most sense for our friends, for our investors, for our clients. So that's first and foremost. So typically when you're invested with one mutual fund company, because the portfolios are remarkably similar in size, the growth portfolio might have Apple stock at 5%, and then the value portfolio might have Apple stock at 3%, and then and so it just goes on and on and on with all these different stocks. And so it's essentially the same portfolio, but just different weightings inside. That's typically what we find when we do these, what we call X-rays, into these concentrated in one mutual fund portfolios. And you get that X-ray, and it's very revealing. You say, oh my God, it's the same portfolio. Therefore, you're going to have the same tax consequences, just give or take a little bit. So you could have a really big tax year, or you could have a year with no tax. Year with no taxes is good, but when you have a really big tax year, you could be in a higher tax bracket. The potential for that exists. And so you're really not controlling taxes or minimizing taxes. You're not managing that tax cost in your portfolio. We believe that you should have control, and you can delegate that to us, your investment advisor, to work with you on that and report to you about that.
Absolutely. Okay, let's move on to the last reason of these 3 that we want to cover today, specialization. Bob, let's talk about that.
Yep. So specialization involves, if you think about the sports world and how specialized things are today, you very rarely see athletes cross over from one sport to the next, or dual sport athletes anymore. Back in the day, you saw Deion Sanders playing baseball and football, and Herschel Walker did the same thing. Today, that just doesn't exist. The athletes, the very best athletes, are specialists in either golf or tennis or whatever it might be. They've trained for that. They've refined their skill. The same thing is in the investment business. It's the same thing. The very best managers in management are usually specialists. So at H&A, all the academic studies, our research for years shows that by having specialists in each of these different sub-asset classes makes the most sense. You have the highest return potential. You have the best opportunity to reduce risk or volatility in your portfolio. And so that's gives you the best results over time.
To get specialization in each of those asset classes, typically you do need to go from one mutual fund company to another. Those specialists are, you know, spread out over different mutual fund companies. They're not all within one company. Isn't that right?
That's correct. Yep.
So
yeah, I mean, in the mutual fund business, you might have a manager that's a specialist in international investing, and then he may even drill down further and say, you know, they might be a specialist in emerging markets, or you might have another manager who's a specialist with small company stocks or even microcap stocks. And if they're specialists, and those areas tend to be under-researched, so there's more opportunity, and that's why you want to hire that specialist, because they're there, they're on site, they know that area, and they're going to give us the best potential for really good risk-adjusted results.
Absolutely. Okay, so those are the 3 reasons that we've identified you should really consider diversifying your mutual fund companies. If you have any questions, please email us or call us at 412-261-5966. This is, again, a pop-up episode, so we're not taking any questions today live, but our emails are at the bottom of the screen, our numbers at the bottom of the screen as well. Please use us as a resource. And tune in 2 weeks from today, and we will see you guys next time. Thanks, everybody.